At Gridcog, we don't claim to see the future, but we do help you plan for it. In the real world, optimizing batteries, EV fleets, or flexible loads means making decisions based on forecast price signals and demand. These forecasts aren't always right. Maybe your battery could make a killing in the intraday market, but only if it's charged in time. Or maybe you want to charge your EVs when the price is lowest, but do you know exactly when that will be? Most modeling software assumes perfect foresight, buying the lows and selling the highs, charging with solar, discharging at peaks. This is great for upper bound forecasts, which is a fair way to model, but you could argue that it doesn't reflect real life. That's why Gridcog lets you introduce uncertainty into your models, so your simulations more closely reflect real-world imperfections. Gridcog allows users to simulate noisy, real-world forecasts using smoothing techniques. The first of these is Exponential Moving Average, which is a weighted average that emphasizes recent price data by assigning it a greater weight than older data. This allows the DEMA to respond more quickly to market changes. By additionally applying a smoothing factor, it reduces short-term noise while preserving the underlying trend. Second, we have Double Exponential Moving Average, which is even more sensitive to recent price movements, offering faster reaction times than DEMA. However, it still trails slightly behind real-time price shifts, reflecting the natural delays present in real-world trading decisions. And then there's Shaped Moving Average. This blends DEMA with historic price trends. You can apply these to both wholesale and ancillary markets. Gridcog also allows you to apply similar uncertainty methods to load and generation, but that's for another video. Let's take an example of how you could add this to your Gridcog model. Let's say you're modeling a 5 megawatt battery in England exposed to the 3 wholesale markets. In Gridcog, go to the commercial model. Select your tariff, choose an uncertainty method, set your span hours to control how much smoothing is applied. Shorter spans means closer to reality, longer spans is smoother, but may miss predictable patterns like the duck curve. Let's see how this comes together in the results. Let's look at a battery on the 8th of January 2025 as an example. Notice how the perfect foresight scenario using actual prices trades between 12:30 p.m. and 7 p.m., capturing the optimal value by buying in the day-ahead market and selling into the intraday market. Let's compare that to DEMA. Here you'll notice how the battery trades suboptimally over a longer period of time. It does this using the smoothed out price curves to make trade decisions. If you're interested in reading a more detailed comparison of the other uncertainty methods, check out our recent blog on our website. For energy developers and investors, understanding how flexible assets interact with market volatility is crucial for financial success. As renewables grow, price volatility will too. New rules like P415 will unlock even more revenue for flexible assets, but only if you understand how imperfect forecasts impact returns. Rarely does a battery investment, be it behind the meter or front of meter, make sense without price arbitrage, which comes from volatility. Gridcog helps you model these futures realistically so you can make smarter project decisions today. Thanks for watching.